Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, August 1st, 4:55 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend. You can see over here on the trend gauge, leaders, neutral but improving. We're seeing some good action, especially some day two, day three, day four higher highs after earnings gaps up. That's not something we saw much at all during uh, 2022 while we were selling off. So a little bit of a green shoot there. Short-term and medium-term trend, looking at the five major averages and where they are versus their 21 and 50-day moving average. We're firmly above those, so bullish uptrend for those, but below the 200-day moving average. As long as we're below this, we're just in a bear market rally, a long-term bear market rally, but when we're rallying, we want to participate. Some decent gains in our portfolios, better gains on the indexes, but the increased participation in leaders and the way they're holding up, not the way they're not selling off after having nice moves up. So we're definitely seeing that. It's definitely a good sign compared to what we had been seeing in the early part of 2022 and all throughout the summer now. But there's a but coming, and I'll show it when we take a look at the tail of the tape. So what happened today? Healthy pause after three big up days. Not a problem at all. No deterioration in anything that I saw. In fact, I saw really more good news than bad news, despite finishing red on the day across the board. G6, this is our growth proxy composite index, positive on the day, just barely, but up 0.05%. S&P down 1/3%, NASDAQ 100. Negative reversal, was up over 1% at one time, finished barely red, but off the bottom. Dow Jones Industrial Average down 0.14. Mid caps barely negative. Russell 2000 small caps down 1/10%. Diversified Global 60/40 stock bond just barely in the red. In-house GROTECTION down 0.24%. Let's get to the tail of the tape and charts of interest in a minute. But first, let's take a look at what we do here at Revere and explain it to you in a chart mode. When we're participating in uptrends, or when the market is uptrending, regardless of the time frame that it's across, it can be, as you can see in the trend gauge here, we take a look at three different time frames as well as leadership stocks. And when we're trending higher across three time frames, that's when we want to be at a maximum all in, so to speak. For a poker euphemism, we want to have as much invested in the market as we can, taking advantage of the uptrend. All uptrends eventually come to an end. Sometimes they come to an end just over a short-term basis, sometimes over a short and medium-term basis, and sometimes, like in COVID and like in 2022, a short, medium, and long-term. At that point, we start to back off when we see we're coming down. Then we want to see how far it's going to get. If it's mild, we just go kind of neutral. If it's a hard sell-off like we see here, and especially when we get under this black line, the 200-day moving average, that's when markets are at their most risky, and that's when we are in full protection mode, especially when we're downtrending under the shorter term averages and as they flip below the higher term moving averages. So this is the way you want to see them here, with the shorter term above the medium term, above the long term. When they start to flip, you got to get concerned. And when they're stacked like this, with the shorter term at the bottom, then medium term, then long term, that's a sign that there is a lot of risk in the market. Now we're starting to turn higher. You can see the slower term, or the short term 21-day moving average. That's the green line coming up through the 50. That's the red line, but we're still below this ominous black 200-day moving average. So we participate when we get uptrends like this, especially when we take a first step above the 21-day moving average. And then when we get participation by leading stocks, we put more money to work. And if you are interested in an approach like this, reach out to me. Love to talk to you. Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732 59.32. As I said, here's your S&P 500. Let's bring up the tail of the tape and mesh the two of them together. So we've got the same headwinds as we've had for a while. Put call has been hanging around 1 forever. VIX up big today, actually up 7.1%, despite the fact that we were barely down on the indexes. Wonder if this has anything to do with it down here. We just had a plus 9% July, but we're entering the worst part of the year from historical returns for markets. August and September are the weakest times for the markets, and maybe that's part of the issue, maybe not. We don't know for certain. What we do is keep an eye on what's going on with the leading stocks and the indexes and react accordingly. Just because it's seasonal weakness doesn't mean we're going to sell a whole lot of holdings, because it's very clear that things don't always work out as you have them planned in the market. So sell in May and go away doesn't always work. We take our cues from what's actually going on, not what's supposed to go on. Some news today: Celsius. Unfortunately, we got stopped on this before the Fed, but up 11% on a big distribution deal with Pepsi. Pepsi adding, investing money in Celsius, also certainly going to kick up their distribution. We've got a historical precedent for stocks like this. Hot beverages, not hot. They're a cold beverage, but hot from a standpoint of popularity. Beverages. Hansen, which became Monster, one of the all-time big moving stocks. So we are keeping an eye on it, looking for a more favorable entry point. Some notes: we've got the US dollar, which has been a drag on the market. Under the 21-day exponential moving average. It's been pulling back for a while. Let's take a look at that very quickly before we go to the rest of the indexes. And it peaked here on 714, and that was very close to the bottom of the indexes. So you can see the pullback since then. We're still above the 50-day moving average, but below the 21, and the 21 is rolling over. That's good sign for bulls, as a weak dollar is better for U.S. equities. Tesla battled the 200-day moving average today and failed, but not a big deal, as it's been a very nice move off of its earnings run. We're also waiting for the moving averages to catch up to this one, as this looks like it wants to be a leader if the markets continue to progress higher. I mentioned the seasonal weakness, and I did mention we're seeing more day 2, day 3, day 4 higher highs after earnings gaps up. Let's take a look at a couple of them here. Probably the strongest stock in the market, Enphase, actually making a day 4 higher high today after its big earnings report before pulling back later in the day. Seeing a lot of this. Several stocks continuing higher after their earnings. How about Ford? I think that's another one that did it today that I was looking at. Yep, here's your earnings. Day 4 higher high for Ford after its earnings report also. That's a good sign for the market. So coming into today, we're watching and expecting. I added this expectation line in here because it's not only, what are we watching? That doesn't really tell you anything. We do have a certain expectation. We don't predict. But based on what's the action in the market, we have an expectation that it will continue to do what it's doing until those expectations get broken. Then we take appropriate action. But we're after 3 strong up days in the indexes. I was expecting base and chop after these 3 up days, plus the fact that we're at a natural pause area with the S&P 500 here. At its 100-day moving average. There you can see the 3 straight big strong up days after the Fed, and surviving the inflation numbers and the GDP numbers and big tech earnings last week. Coming into this downtrending 100-day is a natural spot for us to pause, and that's what we did today. We're kind of battling that area on the S&P 500, also on the NASDAQ 100. Same situation, 2 closes above it, but we did dip below it. There's also a big Fibonacci area here around 315. Let's see, 315.59. is the, let's see, it's the 38.2% retracement of the big move up after COVID. So key area there when you come into it. There's algorithms that take over. There's some natural selling that occurs. So we're cognizant of these types of areas. Just giving us more reason to expect basing or chopping after these three strong up days. So on the S&P, we undercut and closed near support, so that held for today. We got as low as 40.96, closed at 41.19, which is just below this 41.21 support area. This 41.21 is this declining 100-day moving average that I spoke about a second ago. And on the NASDAQ 100, we traversed all three of these areas that we were battling. We undercut this first support area at 314. Today's low is 312.53. This battle back and forth area, this fib level, we closed right below it. We're actually above it after hours. And then this 318 resistance area came up into it. This is above this area here where we consolidated back in late May, early June. Got above that, but closed back below it. So these support resistance areas certainly in play. Strong today, XLP, as let's take a look at Procter & Gamble, which had a bounce back after this ugly earnings. Sometimes, and we see this a couple times, and it certainly happened with Walmart, when you get these inflections. In this case, it wasn't earnings for Walmart, but was a big warning. This gap down got rid of everybody that was a weak holder in Walmart. Look how it's had 4 straight up days since there, and that has carried over to other defensive retail stocks like BJ's, which had the gap down here, finished at the top of the range, put in a nice little flag, and moved off this 21-day moving average today as it tries to break out of this double bottom. Same thing with Costco. Undercut the 200-day, now 4 straight up days. Dollar Tree, same situation. Undercut for up days. Dollar General, undercut for up days. And Ollie, which had a rough time of it, bounced off the 50-day moving average. So you can see I noted defensive retail in here as one of the strongest groups on the day. Also ITB, pretty strong. BLDR, an earnings winner today. You can see this gap up on earnings, almost double average volume, up 8%. These are the types of stocks that are not expected to do well in a rising interest rate environment. We're getting a bunch of details on slowing down construction spending, new home sales, existing home sales, but seen a little bit of relative strength today in Home Depot also. So it's not always the headline that you read. The market tends to look ahead. So those were the strong sectors today. Weak sectors today across the board. Oils, weak pre-market. The dollar, as I mentioned, was weak. That's a good sign. Biotech weak. In fact, we got rid of our XBI at a loss today. Let's take a look at this very quickly. XBI just can't get anything going. It's a tight consolidation, but you can be too tight for too long before you break down, and then you get to the situation where the bottom falls out and it's got to come down and test the 50-day moving average. And we took our small loss on this one. We sold part of it on the failed breakout back here. And when you see a failed breakout in a situation like that, you should have one foot out the door, because when you consolidate, the consolidation should continue higher in the direction of the trend. In this case, the primary trend up with the move off the low. So this failed breakout is turning into a fact where the 21-day moving average is rolling over. So we cut bait on that one today. And commodities were weak across the board today. Copper, oil, gold was strong. Let's take a look at GLD. In fact, GLD has had a few up days, and this coincides with the weakness in the dollar for a while. The strong dollar just was keeping gold held down, but decent move higher the last couple of days with gold. So portfolio changes today. ON Semiconductor, we've been watching this for a while. We noted that this was a big leader back here, but in this last leg down, it got hit really hard. Depth of the base 37%, just a bit more than you would prefer, but it was really just these last 3 days down here where we got rid of the last of the sellers before we started the move higher. So coming up nicely, put in a nice little handle, 3 strong days up coming into earnings. They beat and guided higher, and it gapped down pre-market. But it came down to, let's suppose we had the opportunity to buy this right above the 61.21 high. That's about as far as it came down pre-market, and we took a very small position pre-market and then added to it during the day early in the day as it started working its way higher. Got near the highs of Friday and then started to sell off a little bit into the close. As long as it holds the low of today's gap up, we've got a very easy stop out on this. But we did add a 4% position in ON today on the pullback, and as I said, we stopped out of our remaining 2.4% in biotech. So bottom line, after reviewing all this, tail of the tape, healthy consolidation after 3 strong up days. You can see the support and resistance areas that we're coming into. Here's today's close at 41.19, right around this 100-day moving average. Here's our prior close at 40.20, and above there is this 41.78, top of the range. Let's go back to the S&P 500. Top of the range here from this tight consolidation before that prior CPI report that forced the last big down leg. So far so good. Since we've come off the lows, gotten above the 50 and the 21-day moving average, some participation by leaders, and not really giving back the gains over the last 3 days, despite some negative news headlines last week with the data that came out, and that's what we want to keep an eye on, is how are the indexes and how are the leaders reacting, not the news. It's the reaction to the news that's important. So back to taking a look at a couple of stocks before we wrap up here. I showed Celsius. Li Auto was a leader for a while. In fact, the only stock during this last sell-off, you can see this last sell-off in this black line here, that's the S&P 500, while Li Auto was outperforming. Then it went sideways and rolled over, but bounced off its 50-day moving average. Possible low-risk entry today, but again, it is a Chinese stock. But the EV stocks really had a decent day today, early until they started selling off at the end. As I mentioned, Tesla near the 200-day moving average. So 2 things that we're watching really closely. Apple, with its gap up last week, had an inside day. This is exactly what you want to see, considering that Apple had a big run up off of the lows from 129 back all the way up to 160 here. Gets above the black line, the 200-day moving average. The tighter and the closer you can get to this 200-day, as long as the market and the NASDAQ 100 and the S&P for that matter hold up, very low risk entry on Apple and also on Amazon, and we're stalking these very closely. On the other hand, you can see Amazon actually poked its head above the prior high and closed inside the body of the prior. But we are looking at these very closely for an entry. We like the gap up. We like the volume. What we don't like is the fact that the NASDAQ 100 did have these 3 sharp days up and is battling around this 100-day moving average. But if the strength continues, Apple and Amazon are certainly going to participate, and we're keeping a close eye on those. Google also had a nice reaction to its earnings report, and it's consolidating after 3 days up also. This has more overhead supply than Amazon and Apple do, but it's acting good, acting fine, and that also is going to help out the NASDAQ 100. Speaking of the NASDAQ 100, let's get back to it here and note how it is above this 314.56 area that I was talking about. I mentioned those the fib level that's there and around the 100-day moving average. What I didn't do is show the rest of the indexes. Same thing with the S&P 500 is happening on the Dow, battling around this 100-day moving average tight range after 3 up days. No harm done to the Dow today. Then we've got small caps, MDY, also really taking a breath. Really the same for a change, the same pattern on the indexes. You had this move up, you had this nice contraction in here going into Fed day, positive reaction to Fed day, follow-up positive reaction after GDP, follow-up positive reaction after the inflation data, and a tight range day today. And this is there's nothing that I could really complain about here as far as the indexes are behaving and as far as leading stocks are behaving. And that's going to wrap up today's video. As always, love to hear your feedback. You can email me, don@revereasset.com, phone 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much you keep. That's why we're focused on protection when the market calls for it, but we can pivot and start participating and growing accounts as the markets start to give us the opportunities to do that. That's what's important. You can't make the market do something, but you can follow the wave as far as it's going to go. So just the facts here, wrapping up the first day of August. Don Vandenbord telling it like it is. Thanks for listening and have a great day.